market, we'd like to have a little staying power, so that we'll put that in there. So the difference between the 77.91 that we talked about, the natural stop, or the traditional stop, I guess I should say, is 74. So it'd be a risk of $3.91 or $391. Remember, we said we were talking about a max of $400 risk on a trade based on 2% of 20,000. So that is within the risk parameter, but it only allows us at this stage of the trading range here, the trading trend, to go with 100 shares. Now we can, because of where we place that stop, because of what happens in this particular market, you can move that stop up relatively quickly, because you have a situation where the market pretty much advanced in a steady stream higher. There are several ways that you can place a stop. One would be to keep it below that predicted next day low. There are several different ways that can be done. Now we get into a time where, as any market does, it tends to move in little spurts, and then it always has a little reaction. It has to kind of, take a little chance to catch its breath, see what's going on, and whether it wants to move or not move. So we had our predicted lows that we were talking about on August the 4th. We had a predicted low, that pink line there, of 82.89. So in that case, we would have had our stop at 80.89, which would be somewhere in this vicinity, right about in here. Again, I'm just doing a little eyeballing here. So somewhere right in there with that particular stop at 80.89. The market does drop, as you can see. The market did drop that next day. It dropped only down to 81.89 the next day. But so what we have in this particular case, based upon what has happened, with our first kind of our notable setback that we had of any degree, is that we have a potential stop right in this vicinity right here. As you recall, when you look at where this stop is placed, it also kind of matches up with those previous highs that we had earlier, where resistance that we formerly had now becomes support. So it's kind of a nice coincidence when those things occur, and gives you some spots at which to act. Now, if we were using our traditional technical analysis, as I said, you'd want to keep your stop below that particular low. So we're just going to say that we're putting a stop 81.75 or thereabouts. And you notice that in a few weeks, or a couple of weeks, that stop was almost triggered when it got another challenge down to that low. And this was on August 17th. But it survived. We survived that. We're on our way to now looking at the trend. Remember, when we're in at these prices, when we talk about the stops at 82, that we got in a little below 78. So we're talking about a market that is moving in our favor, and there's probably nothing more gratifying, really, in a lot of cases, than finding a market that goes the way you would like it to go, real early in the stream, because that gives you a little bit of confidence to stay with it, to stick with your plan, and to ride it through if that is what your goal is. Now, when we look at this market, again, this is a bit, we have to talk about what is our staying power situation. So we have now shifted, we've survived the initial danger that we faced, the initial risk concerns and all that, getting into the trade. And now it looks like we've done pretty well getting into a trade, but now we have to take a look at what is going to happen from here forward. So the first thing we're going to do is we're going to move up our time frame. We're going to be looking at, let's say, about August 20th, and our end date is going to be, we're going to go out a little ways, because in hindsight, that this particular market stayed on the sideways range for quite a long period of time. So we're going to shift that to March 1st. Going to shift to OK. And now we have, again, maybe a chart that looks a little bit more cluttered, but a little intentionally so, because there are some points to make on here about this particular market and how it could have been traded. How you might have, gotten in or stayed in, or when you had a threat of getting kicked out, abandoning that trend, you'd have some decisions that you have to make. But your goal, remember, we're not talking swing trading, we're not talking any of these other things right in this particular case, but what we are talking about is a position trade where we want to be in for a while. We don't want to necessarily have a situation where we're in for a little while and get out, and we're not that kind of an active trader, or don't intend to be that kind of an active trader, because that's not our particular goal that we're after. We do have a period of time here where we have some decisions that we do have to make. For example, we have a situation where we have the market that reacts a little bit here, reacts here. There are some potential add-on opportunities here. If you're a swing trader, those are the kind of markets that you might want to trade. But again, we're trying to, after we got into our market at 77.91 and we survived our first main stop at 81.75, now we're trading with the market's money, and we would like to ride that if we possibly can. Now, if we were doing traditional analysis and talking about the way most traders are going to be looking at this chart, as the market advances, they're going to keep a stop below the last low. They might, depends a little bit on how tight they want to do this. They're going to keep stops below there. So we're going to, we aren't ashamed to say we're going to look at some of the traditional analysis too, because we have the market's money in hand, and so we're going to put those stops below those noticeable lows, and that occurs in the area of 84, and then 86, and then 89, 90, 91, somewhere right in there. So each time we have a predicted, or a low rather, that is confirmed, we have the possibility of moving our trailing stop up to below that previous low, so that in case the market does turn, we're going to be out. The swing trader, again, is going to be in and out. The position trader is going to be holding. So after we have a series of higher highs, and as I mentioned earlier, we do have the possibility, if you're a little bit venturesome, where you potentially could have traded again this breakout here and added onto your position, build a little bit bigger position as the market moved along. Again, knowing that you have the money that the market has previously given you on the rise to work with. So that's a possibility that you can work with also. As the market then moves on up, we do get to a point in time where things start to get a little wishy-washy and don't go quite in a trending fashion as we would like. Kind of would frustrate maybe traditional traders, swing traders, position traders alike. So we had after a series of higher highs and higher lows, we do have a situation where the price does begin to kind of roll over and start to look a little bit on the soft side, like maybe this is the time that we want to get out. Now, again, do we want to get out? Do we want to kind of hang in? We're position traders. Remember, we're going to try to stay in. So we're going to look at this particular area here as kind of that last line at which, that was our last low. That's where our stop's going to be. So now if that stop weren't hit, if you weren't stopped out, this would be in the January time frame over here. If it weren't hit then, it certainly would have been in February